He talked about people who watched people who watched people. I am now therefore going to be the person who introduces the next speaker. Occasionally we ask one of our members to introduce a speaker when they have been responsible for obtaining them or when they have a special relationship. In this case, I would like to introduce our longtime member, Bill Borman of the CWA, to introduce our next speaker. Thank you.
Thank you, Sarah, and good morning. And for those of you who are in Washington visiting, welcome again to Washington, and I hope you enjoy your stay in our hometown. I'm very honored and pleased to introduce our next speaker because I've known Don for about 25 years now. In fact, he and I both grew up in Washington, D.C. in the 50s and 60s, and we share a passion and love for the city that most people would probably find hard to understand. As a group, newspaper executives are often an unusual lot. From the point of view of unions that deal with them across the bargaining table, they generally fall into two categories: news people or business people. The news people tend to be highly concerned about the quality of their product. The business people prefer to focus on the bottom line. Now, that's not intended as an editorial comment, but simply an observation. Although we prefer to deal with the latter, we have a shared concern for the economic well-being of the company because of our jobs that we depend on. And Don Graham, the Washington Post Company, has a CEO who is both a dedicated news executive and an effective business person. But Don's background is also unusual for some of his other positions. Don cut his teeth in publishing 30-some years ago as a student at Harvard, where he distinguished himself as president of the Harvard Crimson. Not many Harvard grads spent any time in Vietnam. Don did as a member of the Army's 1st Cavalry between 1967 and 1968. Not many news executives know the streets of the city their newspaper serves as well as Don knows the streets of Washington, D.C. Don was an officer with the Metropolitan Police Department after he returned from Vietnam. Then Don worked as a reporter with the Washington Post in various news positions between 1971 and 1976, when he became the general manager and executive vice president. He was appointed publisher of the Washington Post in 1979. In the past year, he relinquished that role as publisher to assume the duties as CEO and chairman of the Washington Post Company. We have negotiated with each other in a collective bargaining situation. We have collaborated on various projects in the newspaper industry and in the city of Washington. I admire and respect Don's professional qualifications and his personal dedication. Throughout his career, Don has maintained the high standards and tradition of the Washington Post as an important element of life of the nation's capital and as a national journalistic institution. Please welcome my friend Don Graham, CEO and chairman of the Washington Post.
Thank you, Bill. Those are very kind words. You couldn't ask for a nicer introduction, and I appreciate the chance to share the podium with you today. Bill and I have known each other so long it's embarrassing since I didn't literally know him when he was setting type at the GPO, but it must have been about 5 minutes later. And as he said, we've known each other with a variety of hats on for many years. Our company isn't that big. We're used to being one of the smaller ones you're hearing from, but today I really feel like a minnow with you're hearing from Kodak and Hewlett-Packard and the Secretary of the Treasury and whatnot. We're not even in the Fortune 500. But I thought a member of your council, Afi Beschloss, long of the World Bank and now of Carlyle Asset Management, suggested I might come talk to you about some of the slightly unusual things we've done over the years as a company, and I thought I would take up the challenge. Our company's done its job a little differently than most since well before I had anything to do with corporate management. Very famously, for 28 years, we were either the only or virtually the only company in the Fortune 1000 with a woman CEO. And my mother has written at length in her autobiography about her bemused relationship with Wall Street. I want to use the opportunity created by your invitation to tell you about a couple of things we've done. One in shareholder communications, one in board review, and one in pension accounting that I hope you'll enjoy knowing about, that aren't adaptable to all companies, but that might be of interest to some of the companies that you work with. And then, no beating around the bush, I'll tell you about one of our aspect of our management that some of you will profoundly disapprove of, but I'd like to suggest that those of you who take that position, your emphasis is not only wrong, but is contributing significantly to the misguided motivation of certain American corporations. So I'll take these topics in sequence. First, shareholder communications, and this part I just think you'll like, and I offer for whatever use it may be to you. We feel that our primary job as a company in financial communications is obviously, we're a very pro-disclosure company. We want to report accurately and completely to the financial community at large, but our first emphasis is on making sure that our own shareholders are fully and completely informed of what's going on in the company. And like all American public companies, our primary way of doing that was an annual meeting. I wish you could be there. No, let me amend that. You're truly lucky not to be. If my mother had written an expanded version of personal history, she would certainly have included comments about how much she hated our annual meeting. Until the last year or two, it was perennially taken over by a cascade of questions about Post and Newsweek editorial policy, to the exclusion of all but a few questions about business. The editorial questions included many from highly committed people and organizations, and the same ones showed up almost every year. The Post company should certainly answer such questions when asked, but they drove out questions about the company's actual operations and business performance and turned our annual meeting into one of the worst in the country, and I know that's quite a statement. Tiring of this, a couple of years ago, our company decided that while there was nothing practical we could do about the quality of our annual meeting, we really owed our shareholders an opportunity to understand what was going on in the company better. Our communications with the investment public at this point included our not very successful annual meeting, the usual written annual report, and a couple trips a year to Wall Street financial conferences to explain our company to board-looking security analysts, few of whom had a stake in us. This put us in the ironic position of focusing our financial communications on people who own none of our stock and largely ignoring the people who do. Furthermore, the nature of our little company was changing. Since going public in 1971, we'd been a company centered around a newspaper, a large magazine, Newsweek, and 6 television stations. Now we had sprouted a growing education division, Kaplan, a highly unusual cable company called Cable One, which I'll almost guarantee none of you have ever heard of, and an internet division that was both growing and losing money faster than all get out at that time. Minority investments in a couple of rapidly growing businesses also were affecting our results. In short, our company had become much more complicated, and we had to figure out a way to explain our financial picture to the people who cared about it the most, the people who owned the company. So 2 years ago, we decided to hold Shareholders' Day. No one was invited but people who own Post company stock. It was webcast for anybody else who might be interested. And we explained that questions about Post and Newsweek editorial policies would be excluded since there was another opportunity to cover those in full. We had never had more than 50 shareholders turn up for an annual meeting, so we made arrangements for a Shareholders' Day crowd of about 35. The response amazed us. 350 shareholders accepted and more than 300 showed up, and we only have about 2,000 shareholders of record. Not only did they come, they asked extraordinarily intelligent questions of the heads of our education, internet, and cable divisions who were doing the presenting. The attendees endured 3 hours of solid presentations in the morning, and most stayed for an hour-and-a-half lunch in which a Post and Newsweek panel of reporters discussed the just completed 2000 presidential election, an unusual panel where no one knew who had won the election at that time. I should admit to you that while this was not in any way our aim in conducting Shareholders' Day, our stock went up $100 a share in the next month from $500 to $600, which may have happened because our existing shareholders liked what they heard and bought more. I was struck by the response from our own stockholders and wondered afterwards why corporations spend so much time and effort communicating with Wall Street analysts who by and large care not a whit about the company's fortunes, and whether most companies might not be better off if they devoted the same effort to communicating with the people who already own the companies. In any event, we're going to conduct our second Shareholders' Day this November. We're not trying to sell anybody anything, and we're not trying to have any effect on our stock price. I'm of the heretical point of view that if the company is reasonably priced to begin with, I shouldn't be trying to have any effect whatsoever on short-term stock prices. But a couple years have gone by, and while we've taken unusual pains in writing to try to tell shareholders about business developments, the Shareholders' Day format gave us far more opportunity to cover them in depth. Second subject, pension accounting. We have paid an unusual amount of attention to this over the years because Warren Buffett joined our board in 1974, and a couple years later recommended 2 brilliant pension fund managers, and as a result our returns have been among the best. This gives us an unusual amount of pension credit, which gives our employees an unusual amount of confidence in the security of their pensions. As to the pension credit, we took to highlighting it in the chairman's letter of our annual report and telling our stockholders that we consider that portion of our earnings to be of lesser quality than the rest of the reported earnings. I don't think we'd have any debate about this. The portion of earnings tied to pension credit represents money a company can't use for any but pension purposes. We also broke out our pension credit by segment, and we actually were complimented in an editorial in Pensions and Investments magazine last year, year before last, on the quality of our pension reporting, surely one of the more abstruse compliments a company can receive. I want to tell you about a decision our board made in January that will reduce our 2002 earnings by $20 million or $1.25 a share, which is a pretty big amount for us. We voted to reduce the expected return on our pension fund investments from 9 to 7.5% and to reduce the discount rate by 0.5% as well. Why? I suspect the reasons are well known to most of you in this room. Warren Buffett wrote an article in the December 11, 2001 issue of Fortune describing the typical management of a corporate pension fund, and as it turned out, my thinking, or the Post Company's thinking, perfectly illustrated what he called setting assumptions by looking in the rearview mirror. Our assumed rate of return on investment had crept up to 9%, mostly justified by the fact that that's what we'd been making, rather than by looking forward and saying, does it make any sense to assume that higher return going on? Warren's article is what we call in Bridge a laydown, and it is on the Berkshire Hathaway website, and I commend it to all of you. It makes an irrefutable case that companies simply cannot assume the type of returns going forward they experienced in the 90s. If you believe that, then the earnings of most older American corporations, those that have defined benefit pension plans, are right now and will be in the future significantly overstated. You can argue about whether our own assumed rate of return has been reduced enough, but for various reasons 7.5% seems a good number to me going forward. But this puts us to the lower range of American corporations in our assumptions. I raise this only to point out what you already know: the huge amounts of money at stake in assumed returns on the pension funds of the companies you're involved with in one way or another. These assumptions drive an awful lot of reported earnings, and those assumptions need to be looked at by corporations today. Finally, board review. We've adopted an unusual policy at the Washington Post Company that's greatly, although to go back to pension reporting, I'd say our assumptions about the return on our own assets were made with our own company's situation in mind, and I'm not saying that our assumption is right for any other company in the United States. It's right for us. And finally, board review. I want to tell you about a highly unusual policy of the Post Company that's greatly benefited our decision making, and that I toss out as an offer free to any company you may be involved with, and it might also be interesting for the funds and other non-corporate organizations you're involved with. In short, whenever our board votes on a major acquisition or capital investment, if such an investment is big enough to bring to our board, we have an unvarying policy that 3 years later, we will come back to the board and report in full on how that acquisition or capital investment worked out. We will start with the slide showing the financial presentation that was made at the time the acquisition or capital investment was rejected, or was presented. And then we will show what has happened in the last 3 years compared to the projections we made for those 3 years. You cannot repeal human nature. The manager of a business naturally wants his or her division to become bigger. But it can be bracing as you prepare for the board pitch that justifies the big deal to realize that you're going to be back before our board, which in recent years has included Warren Buffett, Barry Diller, Dan and Jim Burke, Don Keogh, Bill Ruane, and until recently Kay Graham, among others, to justify your decision and to tell what happened. We have had some highly embarrassing moments talking about lousy investment decisions that we've made. And, you know, we've had some that weren't so lousy. That discipline of knowing that your biggest decisions are going to be reviewed by the people who approved them going in, that you're not going to take the money and disappear, and it has, I think, resulted in better decision-making at the Washington Post Company. And not a bad idea for corporate or foundation boards, as well as for organizations like ours. So far, I make bold to think that many of you may even agree with much of what I've been saying. Everyone's in favor of greater disclosure, and people in this audience understand the importance of pension fund return assumptions. Now I'd like to describe something we do that's different from most companies. It'll go against the most cherished beliefs of some of you, and I'd like to raise the question of whether you may want to reconsider what you're encouraging companies to do. In short, I don't believe that corporations should be managed to achieve specific quarterly earnings targets. I don't think short-term earnings are an appropriate indicator of management quality. I think the gyrations companies are going through to achieve quarterly earnings goals may detract from their attention to growing their businesses in the longer term. And if I were you as investors, that's what I would be focusing on. As I speak to you today, our first quarter is a few days from its end. I do not know what our company will make in earnings per share terms in this quarter. I know how each of our businesses is doing against budget and against last year. And I could tell you what I expect each of these businesses will make for the year as a whole, but I won't, because we don't make any forecasts of any sort. What I cannot tell you is how we will perform against analyst estimates of our quarter, because while there are a few analysts who publish such estimates, I don't know what their estimates are. And so I don't know if we will be higher or lower. Now, I have made a couple speeches on Wall Street and said exactly the same thing in so many words, in the same words, to the analysts and the investment community that follows our company. And I've even added, if any of you are keenly interested in what we'll make in quarterly earnings per share for the next quarter, you probably shouldn't own the stock. Now, I know that this is heresy to some in the generalized movement that you represent. Over a long period, as I understand it, you felt that the managements of the largest American corporations were not sufficiently accountable to shareholders and used alleged long-term thinking as an excuse for lack of profitability. And the bad behavior many of you criticized in those years has most certainly not gone away. However, from the perspective of a non-participant, if you want to hold corporate managements responsible, the corporate/investment community barn dance around quarterly earnings seems a very odd way to do it. A few disclaimers are in order here. I understand that a unique ownership situation puts us in a different place from most companies. The combination of family ownership and Warren Buffett's large participation gives us room to go a different way. I'm also absolutely not holding out the Washington Post Company as a model of how corporations should be managed. We've got pluses and minuses. But tempting though it is to respond to my arguments by looking at our company and asking if it's managed as you would wish, it undoubtedly is not. I ask you to think about the argument that I am making on its merits. And by the way, I also am wholeheartedly agreed that the appropriate target for management is growing the long-term value of the enterprise, which can only be reflected in growing operating income in the long term. That's the only meaningful definition of intrinsic value. But one CEO of a public company, when I asked him why they were so attentive to quarterly earnings, said, because those are the rules of the road. My question for you is, why are those the rules of the road? Do they make sense? And if not, who could change them? Only the other day, in an absolutely typical moment on CNBC, I watched several analysts react to the fact that Cisco had made 9 cents a share for a quarter when analysts had been projecting 10 cents. Now, I don't know one thing about Cisco. I do not understand that business, and perhaps it's just that I come from a different school. But why would that penny in a particular quarter be among, say, the 100 most important factors in anyone's valuation of this large and complicated company? Just knowing the amount of estimating to begin with that has to be done to close the books of a company as small as ours for a quarter or a year, I fail to understand how important that penny a share can be, but I don't need to tell anybody in this room that a penny up or a penny down moves the market value of companies in a big, big way. When the federal government publishes its own quarterly numbers in the form of GDP growth or decline, everybody understands those numbers are subject to revision, that they will be revised and they'll turn out far different than the original figures. Somebody recently told me the government is still revising its annual GDP estimates for the 1940s. Now, I ask you, put yourself in the following position. Assume that you were the sole owner of a business, large or small. You own 100%. You therefore can manage it in any one of a number of ways. You can manage it to make the most money in the quarter, in the year, by whatever definition you hold. You could manage it to employ the largest number of relatives. You could manage it to grow into the biggest possible entity 10 years from now. You could manage it to pioneer in inventions. But if any of you were managing a business that you owned 100%, would you manage it by calling someone at Merrill Lynch or some other company and asking what they thought you should earn for the next 3 months? I don't think that would make sense for you. And I'm at a complete loss to understand why it makes sense for most American corporations. I am not criticizing the behavior of any corporate management that focuses on quarterly results today. They do it because they feel compelled, rightly or wrongly, to do it. And the people who compel them, in their view, are you and your fund manager brethren. You all know as well as I do what the effects of such management are. The corporation may become, to a greater or lesser degree, fixated on its own carefully arrived at projections of what it's supposed to make in the next 3 months. At best, that number is going to be a spur to performance, and managers will somehow use it to make the business more profitable than it otherwise would be. It's probably an overstatement to say that decisions maximizing quarterly gains will adversely affect long-term results. But young people running a division on their way up, they hope, can do all sorts of things to help short-term at the expense of the long-term. At the least, they won't be thinking like an owner. And I don't think they'll be thinking the way you want people running companies you invest in to think, if they're focusing blindly on this quarter's numbers. At worst, and you've seen this countless times, and here I am quoting in part from last year's Berkshire Hathaway annual report, this emphasis on quarters leads to fudging. For example, one very large consumer goods company was found to have stuffed shipments into distribution channels at the end of a quarter so that it could book the revenue. although the channels didn't need them and there was no business reason to do what the company did. I heard one report of a company that sold an airplane on the last day of a quarter and leased it back on the first day of the next quarter to make a profit figure that was important to the CEO. And I've witnessed public companies change the form of an internet partnership they co-owned from an LLC to a corporation, depriving the companies of tax benefits they were entitled to and in some sense tearing up shareholder dollars so they wouldn't have to report the losses. Warren Buffett wrote in a recent Berkshire Hathaway annual about other insurance companies selling Berkshire a huge amount of losses at a price. The transaction smooths out or pretties up the reported earnings of the selling company, but causes the shareholders an economic loss. Do we think those companies are making money unloading losses on Berkshire Hathaway? Or do we think Berkshire is taking advantage of the seller's desire to report smooth earnings? Beyond fudging, of course, can come fraud. Enron is only the most graphic and vivid example of how companies oriented to doing so can twist their financial picture beyond all recognition, not to produce real profits or cash in the bank, but to produce reported results, which, as we know, in Enron's case, pleased legions of analysts until almost the company's dying day. Enron's also a perfect illustration of a problem much larger than quarterly earnings: corporate focus on reported results instead of economic results. But we can't stay here all morning. I'm sounding as if I hold analysts in the financial community uniquely responsible for the quarterly earnings dance, and I expect by now many of you would say to me that you find it is managements who are leading the way, and for all I know this may be true. But I wonder what the effect might be if a few of your organizations were to announce that this isn't the way you want to judge corporate performance going forward, that instead you're going to try to look for managements that are genuinely and successfully building long-term value for shareholders, even though that analysis may be significantly harder than figuring out who's going to make 9 or 10 cents for the next quarter. It strikes me that you and some large companies have locked yourself into a somewhat odd system of management, and some of you are in better position to change that system than anyone else I can think of. Thank you, and I'll be delighted to take questions. Shoot.
Yes, I'm Bill Chris from CalPERS, and I don't think you shouldn't be. I'm too shocked to learn that many of us in this room, in fact, do agree with the major thrust of your remarks, and that we see short-termism as a fundamental weakness of our system and would prefer it if there were more long-term considerations. In fact, I would like to ask for a poll, a show of hands, just for the fun of it. The question being put only to pension fund managers in the room or trustees, public, labor, and private. How many would prefer and do attempt to practice long-term investment considerations as opposed to the alternative of investment determinations made on quarterly analysis? How many? So we are somewhat...
Want to pose the other half of the question?
Absolutely, absolutely. Voting by pension fund managers or trustees here, how many would prefer and do practice their investment strategies on the basis of quarterly analysis and returns as opposed to long-term considerations?
God, what an unusual group.
Actually, sir, we're not an unusual group. There are different kinds of institutional investors in the world economy, and public and pension investors are perhaps not unique, but a different group. I do agree with one thing you said very strongly, and that is that we're perhaps not doing enough to change the rules if the rules of the game in the market are that you must pay. If you're management, if you're corporate management or corporate board, you must do everything you do on the basis of that quarterly report. We need to do more to change that. And some of the things that have to do with paying options, with the repricing of options, with the either costing improperly or not costing out options, those are things that that managers and corporate boards allow because they're greedy. And these are things that we would like to change, and I believe that then we'll see the change that you recommend. Thank you.
Thanks.
Hi, Chuck Valdez from CalPERS, same organization as Bill. I appeared before a congressional committee here on the subject of why are we focusing in on short term, and surprised the entire committee by pointing out that we're the ultimate in long-term patient capital. And it's as a result of our style of investment. We have over $100 billion just in domestic equity that is passively indexed. And a passive index, the discipline is you buy and you hold. And it was precisely because we weren't going to take the Wall Street walk as one way of saying we were upset with a particular corporation, that we were one of the founders of this organization. We wanted a way to affect corporate activity other than by selling our shares. In point of fact, we have less of a turnover than almost any other public pension fund institutional organization that we're aware of. If you really want to look at the reason why there is a short-term quarterly dance, how much in the way of millions do you think Lay, Skilling, and Fastow would have gotten if they didn't raise the price, if they didn't have this quarterly earnings dance? Got to look at some of the options compensation to find one of the reasons why some of that activity takes place.
So you actually stay up there. I got a question for you. I mean, I'm fascinated by the show of hands that your colleague asked for, and that's the question I wanted to put to you is if the institutions in this room are leaning hard in the other direction toward focusing companies on long-term performance and the increase in long-term value, why then do all public companies, including many that would like not to be judged this way, view this quarterly business as the rules of the road?
Well, options is one of the reasons. The other is that analysts want to be able to give those reports showing an increase in profitability or earnings or share value or whatever. And then it's the retail market and some others that are turnover artists. I mean, there are a number of private groups that turn over their portfolios several 100% per year. We have less than 10%, I think, per year.
Mm-hmm. So you see it as management's driving it and analysts driving it. It's interesting.
Analyst, management, retail market. Yeah. It's not the institutional holders. Our ultimate philosophy is buy and hold.
Well, you know a lot more about the subject than I do, that's for sure.
Thank you, sir.
Thank you.
Dan Slack, Illinois State Universities. And I'm wondering if you'd like to comment about the media, because I wonder about quarterly earnings, if it's not a need to fill up the financial news channels.
Well, I don't know anything about the management of those channels, but it's an interesting question. And certainly, as in the example I used, there's plenty of comment about quarterly earnings targets and their achievement or non-achievement. But I have a feeling, I don't know the answer to that. We don't have any majority of, do I wish we owned CNBC? But I'd love to know more about that subject. But I do know quite a lot of reporters, and the reporters any good reporter wants to reflect what they take to be the consensus of intelligent people about what's truly important. And I suspect CNBC is putting those stories on the air because that's what the most informed, authoritative people, corporate managements in the financial community as they perceive it, focus them on. I don't want to be defensive on their behalf, but I would guess that's what their answer would be, and I'd have a hard time arguing with that.
I want to change the subject, if I could, just
Please.
a slight bit. You're uniquely positioned to respond to this question. What do you give as odds that Congress or the SEC or the administration are going to do anything meaningful in the way of reform in light of Enron?
Well, I think that depends on your definition of meaningful. I think it's... Yeah. I think it's overwhelmingly likely that Congress will do something. I think it's very much up in the air what they'll do. As everyone knows, I guess, as has been written about extensively, the Senate and the House seem to have different priorities in what they're pushing. And I think that, you know, how extensive changes in SEC regulations will be is anybody's guess. I do think that the behavior of companies, the behavior of auditors, the behavior of the financial community has clearly to some degree changed. This is not a subject I report on or focus on from day to day, but it is in the air that the quality of disclosure, the quality of reported numbers are getting attention like they never got before since the disclosure that this one company was reporting numbers that ultimately had nothing behind them. And that is unregulated, unlegislated reform, but it is to some degree happening in the short term. And how all three of those, the regulatory aspect, the legislative aspect, and the corporate behavior aspect, are going to play out is hard to, you just can't know at this point. But plainly, corporations feel under different kinds of pressure than they did pre-Enron.
Mr. Valdez mentioned was options. You didn't refer to it all in your speech. I think you had a piece yesterday in the financial section of your paper about the importance of options and compensation. And how much has that driven the bubble and the burst in the bubble? And that is options, the granting of options, the pricing of options, and even worse, the repricing of options. And is there any reform likely in that area?
Well, I don't want to... I'm not in a great position to comment knowledgeably on that. Options are an unusually small aspect of incentive compensation at the Washington Post Company. I myself have none and never have had any. And but I obviously am a very significant stockholder, and I'm very focused on the value of the stock, and don't need further incentive to do so. But you know, two of you having raised the subject, I just have to say I can't knowledgeably comment on that, except that it's obviously, as your questions imply, to some degree a factor in what you're discussing. And certainly it's the accounting treatment of stock options is an extreme hot button in Washington at the moment, with some legislative proposals to change it. Apparently it is said in the press, with Chairman Greenspan weighing in favor of changing it, and many companies objecting strenuously on the other side.
Hi, I'd like to take the other side of the coin.
Please.
To your discussion of earnings and the release of earnings. And I agree with you in principle to what you're saying, and I also think that you're seeing the majority of people in this room who are wholeheartedly saying that they are long-term investors. I think the problem that you're facing with this issue is that there's an even higher awareness and level of accountability these days. And I think that quarterly earnings reports for corporations reflect a way in which these corporations are reporting to us on a routine basis as shareholders. And I think then that you're right, there is the potential to game this a little bit on a short-term basis. But I think that as long-term investors, we recognize that if you game it short-term, at some point it's going to backfire on you. And I think long-term, the companies that have done well have been the ones that have managed their earnings appropriately.
It's a very intelligent statement of the pro position. And no, I mean, I think that is absolutely the best way to argue for the focus on quarters. Again, it seems to me that the appropriate way to judge the management of a company is whether over the long term it causes the value, what Buffett calls the intrinsic value of the company, to go up. And if it causes that value to go up, there's only one way that that's going to be reflected, and that's in net income. You know, that is the ultimate definition of value, is the discounted cash flows that you're going to derive from a business. And then you get to the question, does a pattern of quarterly earnings define the achievement of that goal? Do companies that have achieved that goal show a pretty and predictable pattern of quarterly earnings, or you know, Kay Graham once made a speech in which he said, I would rather go from X to 5X in a jagged pattern than from X to 4X in a nice smooth line. And, you know, that is honestly the way I feel. I do spend a lot of time watching Berkshire, and the quarterly earnings pattern of that company have vibrated all over the place. Way the hell up one quarter, way the hell down the next quarter. But an investor watching that company has to believe that there is a management totally focused on creating long-term value and on the whole highly successful at it. It didn't reflect it at all in quarters.
I agree with you on that. Yeah. I also think that it comes down to how effectively the corporation communicates this and manages the expectations of their earnings. Right. And I think as long as the long-term results are what is expected, then that is acceptable, and you can have varying patterns.
Yeah, that's true. And I should add that, you know, since I'm mentioning Berkshire more than once here, I didn't show this speech to Mr. Buffett, and, you know, no, I mean, it's me, not him doing the talking here, and I want to disclaim any responsibility on his part for anything I'm saying, but I find your focus on long-term growth admirable. I think it strikes me as kind of questionable that long-term growth can be divided into nice, neat 3-month segments. You know, maybe there are some businesses where it can, but even a little business like ours seems to bob up and down erratically.
What is your solution?
Well, it's, as I said, it is harder to focus on the successful creation of long-term value and to piece together who's doing it and who just claims to be doing it. But that, you know, I think that is the one and only job of a good corporate management. And it strikes me that, you know, and we believe in making profits grow. If you don't believe me, ask him. But we are focused on what we think to be the appropriate goal of long-term investors. And as I said, I'm not holding out our company as a model of brilliant corporate performance. We got our pluses and minuses. But I do think that investors as astute as yours can disentangle who is genuinely building the long-term value of the companies they operate with a little more difficulty than you can take a company's quarterly target and seeing whether they're up or down a penny a share. But, you know, that is what I would suggest from my own quite narrow experience is the appropriate way for companies to proceed. Thank you.
On the same subject, maybe it takes two to tango, in that a company's multiple, in a sense, is the direct reflection of their cost of capital. And thus, in order to maximize intrinsic value, your goal is to minimize your cost of capital and thus maximize the price earnings multiple. And thus companies and managements are co-conspirators with Wall Street with respect to maximizing the multiple to issue stock or feed the ducks when they're quacking. And is it not where we're seeing the biggest quarterly focus and earnings blow-ups happen to be in the companies with the highest multiples in a value realm, or the lower multiples that a company hits or doesn't hit earnings? There usually may not be any expectations whatsoever. Case in point, the difference between small cap and large cap, where there is no analyst coverage to speak of, and earnings variability on a quarterly basis does not necessarily impact low multiple companies as they do, well, shall we say, where the air is thin.
That is an absolutely great question, and my only reply can be, again, my corporate experience is narrow. I look at our company and our industry, and 20 times more about the answer to your question than I do. But there are a lot of companies out there who believe that their objective as corporate management is to keep that multiple as high as it possibly can be forever. And there aren't many cases of companies that have actually done that, of going on for years and years at 50 times or 100 times earnings so that they can, keep that price.
Maybe it is your shareholder days process that can build a long-term investor focus on those long-term results.
Well, yeah, but your question's a good one, and there are certainly companies that believe that keeping that multiple up as high as possible and using the stock as you described is the appropriate way to do it. And you know way more than I do about how successful companies have been at achieving that result over the years. I don't see a hell of a lot that have done so.
I hope this isn't a softball for you, because it has nothing to do with investing or corporate governance. With the advent of the internet as a source of information and the need of the public for the quick soundbite, how do you see the media industry in general and the print media in particular changing going forward?
Well, it's changing big time. We in the newspaper business all know that, ironically, the internet has greatly expanded the audience for what we do, and that hasn't been reflected to date in the profits of any of the companies undertaking it. But it is clear that in the last few years a giant new news medium has been created, and it's fascinating for the Post because we are a locally focused newspaper. We're in the capital of the United States, so we devote a tremendous amount of attention to covering national and international news. But we physically distribute the newspapers only within a few miles of this hotel. 95+% of our circulation's within 50 miles of the shore. In Maryland and Virginia, we reach very far out. But we don't distribute papers more than a 7 or 8 hour bus ride from our printing plants. And suddenly, thanks to the internet, our journalism has a huge national and international audience that didn't have before. It is the very early stage of learning the answer to your question. But the size, the scale of the audiences for some of these big news websites is absolutely staggering. I do think that you talked about the need for news bites and constant updating, and that's absolutely true. People look at the internet all the time, among other things, to see headlines. But I don't think the quality news organizations that pour an exceptional amount of effort into good journalism and reporting are going to be badly served by the internet. I think in addition to the hunger for headlines, there's also some hunger for depth and substance that ultimately is going to reflect in large audiences and quality audiences for the news organizations providing it. Although, as I say, to date, the business story is different for the internet than it is for traditional media. But this is going to be a very interesting thing to watch going forward, and we like the role we think we can play and the results we hope it'll achieve for shareholders. Thank you very much.